Good morning, everyone, and welcome to our webinar introducing NGL's new LTCi with NGL's Larry Moore and Ames Don Erickson. Today's webinar will be recorded and then later posted on our website. This does mean that all attendees will be automatically muted so that we get a quality recording. If you have any questions, go ahead and type them into the chat box, and we'll try to answer them throughout the presentation. But if we're unable to get to all the questions, we'll have a member of our marketing team reach out to you individually to make sure you get that answered. And folks, if you could just hold on for 1 second, we're working through some technical difficulties. We will be right back.
Did.
Hey Larry, there you are.
All right.
Alrighty. So we'll go ahead and get Larry's screen shared.
There it is.
Awesome. And then I'll give it over to Dawn.
Thank you, Jordan. Good morning, everyone. Hope everybody's doing well today. It's Christmas season, everybody's looking for the holidays, family, and all that stuff. Today, we actually have a special guest again with us that he actually has worked in our office with us a few times. He's been through the long-term care. He knows the arena very well. He's with NGL, that is our Larry Moore. Hey, good morning, Larry. How are we doing today?
I'm doing good, Don. How about you?
Hey, and we're hanging in there. I know the
Good.
wife and grandkids are looking forward to some snow and some Christmas.
There you go. There you go.
So I know we're talking about NGLs and they're going to be introducing their Honest LTC, their new product. And I don't want to steal your thunder, so I'm going to kind of let you go ahead and go through it.
Okay, Don, here we go. Well, thanks for having me, and good morning, everyone. Um, NGL is going to be releasing our newest addition to our long-term care insurance family called Honest LTC. And why the word honest? We were trying to figure out what do we call this new product, and at the end of the day, everything's transparent about it. It's very straightforward protection. That's what we love about the traditional LTC space. And with this product, it's going to carry a lot of improvements over what's already a very good product, which we'll talk about. But it's interesting. It's been one of the longest and slowest product launches I think I've experienced in my 30-year history. So it is not yet available. But once it is, and I think what you'll do, you'll see it probably roll out sometime in January. And we're going to roll out in this group of compact states that you see up there. Of course, Washington's one of them. I don't have a date yet, and I'll be working closely with Don, and we will certainly let you know once it's officially out. In fact, we may do a follow-up to this call just to reintroduce it. The product's approved, the rates are approved. You can't quote it yet. We're just going back with the compact on some administrative matters as it relates to forms filing, and that's it. So, like I said, the launch date to be announced. But that said, any LTC business you wrote with us after May 1st of this year will be eligible for a guaranteed issue exchange to the new product once the new product's out. So if you've written NGL, our current essential LTC product, anytime after May 1st, the product's in place. When the new product comes out, take a look at our rates, and you'll find that the rates are extremely competitive. You may want to share with your client. There's an updated version of what they have out there. It's available, and I can probably get you on there without any underwriting. So it's kind of a good thing. So keep in mind, these are the initial launch states that you see up there from Alaska to Wyoming. Those are the states. As far as what the product's all about, currently, probably our strongest aspect of what's available with Essential LTC is our joint product with what we call the shared benefit amount rider, the third pool. And those two key features are still part of our LTC family and part of Honest LTC. So that means we have unique pricing for couples in the form of a joint product. And then if you want to further expand the leverage, instead of a shared care option like you might see with Mutual of Omaha or Thrivent, we actually add a third pool of benefits that replicates the insurance policy that your clients already own as a joint couple, right? And in terms of how we define couple, it's very loose. It literally can mean any couple that you can imagine as long as you're living under the same roof and sharing expenses, right? We have, along with the life pay option, our 10 pay option will still be available. We're doing away with our single pay. We did two important things to keep our pricing competitive, and kind of the fancy word is de-risking the product. We have done away with lifetime benefits, which we never really sold anyway, and our single pay. Right now, they're still available, but when the new product comes out and replaces the old product, uh, you won't see a lifetime option and you won't see a single pay. We still have benefit periods of 2 years, 3 years, 4 years, 5 years, and of course, 6 years. Elimination periods, 90 days and 180 days. The big change in our elimination period, as you'll see in the next page, is important, and I'll share that with you in a moment. We also have our what we call our first day home and community care rider. That means that you can add a rider, regardless of what elimination period you have. You can add a rider for only 10% more premium that will make a 0-day wait for home care. People like that idea because they'd rather stay home as long as they possibly can. So that option will be available too. So getting into the important changes, we're increasing the benefit limits. Right now, the current product goes up to $300 a day, which is like $9,000 a month. The new product's going to go anywhere between $1,500 and $12,000 in monthly benefits, and it's a monthly benefit, no longer a daily benefit. So the advantage there is that if you have, say, a $6,000 a month benefit, you can utilize that $6,000 any way you see fit. You're not limited to $200 a day increments, in other words. So that adds a lot of flexibility. The elimination period has improved as well. We went from a service day elimination period to what we call a calendar day option. Calendar day is appealing, at least on paper, because it again gives the client more flexibility and greater speed at which they can satisfy their elimination period. What do I mean by greater speed? Well, with a service day elimination period, which is less expensive to be fair, means that you're only knocking days off the elimination period based on actual days of service you receive. With a calendar day elimination period, if you even utilize services one day in a 7-day week, you've taken care of that whole week. So it is advantageous should you be utilizing and requiring services every day. We've also increased the number of inflation options available to you, 1% all the way up to 5% compound. And of course, those are lifetime inflation options, meaning that they will continue to inflate the benefits as long as you own that policy. And even when you're in claim, you're going to see your monthly benefit and the remaining pool of money grow. Other changes that are also important. We are now recognizing individuals who are part of a couple, even if only one applies, meaning 5% partner discount. We have seen many situations where if a couple applies and one is declined, then you're down to an individual rate, which is not as advantageous as being able to discount the healthy person. So there is a 5% partner discount that we currently don't have. Another important change, the current product is built around the idea of age being your age nearest. And I don't want to go too deep in the weeds with that, but what we have right now, after 6 months, after you've had your birthday, we now see you actually as a year older. It's a problem. It doesn't really hurt people, but it adds confusion. We're going to go to actual age. So whatever your age is, date of birth doesn't really matter. It's what your actual age is, and that's what we base the premium on. Also, we're throwing in alternate plan of care. We've unofficially had it, interestingly enough. At the time of claim, if you're in a rural area and they don't have conventional home care services or conventional long-term care institutional facilities available, we would then consider alternatives. And the argument was, well, if we're doing that anyway, why wouldn't we say it? So kind of in the honest theme, we have alternate plan of care. And that's a great way to keep your coverage relevant for the future. Because if we go back in time, I started in this industry in 1990. Don started a long, long time ago too. We remember those days just when assisted living was starting to come on the scene. And it became a much more appealing way to receive care if you couldn't receive it in your home. So alternate plan of care would have made that possible. So that's why it is a real important feature to have. Looking at the premiums, as I mentioned earlier, one of the most important aspects of this product is that we're able to offer an enriched product for very little difference in premium, anywhere from 3 to 9%. And I'm going to share with you some sample premiums to give you a sense of where we land with the new product. Where you see yellow, that means that we win. So from left to right, you'll see NGL, Mutual of Omaha, and Thrivent. This is a joint policy, so two individuals, 3-year benefit, 90-day elimination period, $4,500 monthly benefits, 3% compound. We have our shared third pool compared to their shared care. So when you go from left to right, we'll just take age 50 to keep it simple. That is our premium, $4,294, and take note of the size of the pool of money, $486,000. You're paying less premium to actually have more benefit. Mutual of Omaha's premium is over $5,000 a month for less benefit. Thrivent is at $4,500 a month for less benefit. So when you look at the meat of our market, right around age 60, again, for couples, we play very well there, right? 57, 85 for more benefit than the others provide. And then you just look from left to right, the premium. Mutual of Omaha's almost $1,000 a month, a year more. And Thrivent, about $800 a year more. So when you look at couples with the new product, Honest LTC, we play very well. To give you some contrast, we're going to look at a joint product and then adding in the 0-day waiver of elimination period for home care. So this is like saying that you've got a 90-day wait for the facility, but if you want to claim for home care benefits, there is no wait. And something real important to keep in mind that we don't state here is that, let's say I do take the 0-day wait on home care and start receiving my benefits at home. Every day that I'm receiving benefits at home on a calendar day basis is knocking days off the 90-day elimination period for the facility. So if I happen to be home for 90 days and then it's admitted and realized that I need to really be in a facility, well, you've already taken care of that elimination period. So they're across the board again, with more benefit, we're charging less premium, even if we have the 0-day wait for home care. So very competitive there. So I've been showing you 3-year options just for the fun. I thought I'd show you a 5-year. So in this case, I have 5 years without the third pool just to keep the numbers cleaner and simpler. 90-day elimination period, $4,500 a month. And same deal. You'll notice the pools of money are the same since I'm not throwing in the third pool and we're not incorporating shared care with Mutual of Omaha and Thrivent. But again, where you see yellow, we win, right? So that's for couples. And I think it's safe to say that even right now, and Don's talked about this too, for couples, we pretty much dominate that space. Looking at female rates, we still play pretty well. The field gets a little tighter, but here's a 3-year benefit scenario, $6,000 a month, 3% compound, 90-day elimination period. And again, for females, we play very well, right? Across the board, we win. Even though the benefit limits are the same, our premium is more competitive across the board. Looking at the 0-day wait for home care, again, even with females, we're still doing quite well, especially against Mutual of Omaha. We're pretty close with Thrivent, but with Mutual of Omaha, it's pretty safe to say that we beat them across the board, okay? And then again, for the fun of it, we'll throw in the 5-year, same deal. We play very well. Okay, we give you $6,000 a year or more in benefits based on how the numbers work out, which is kind of funny, but nonetheless, from a premium standpoint, we're very well positioned, okay? As it relates to males, it's a little more of a mixed bag. When we look at a single male on our 3-year plan, $6,000 a month, we win in most categories, right? But then Thrivent takes a few from us there. Mutual of Omaha beats us at age 75, but I will tell you we write very little business in that age 70 to 75-year-old segment. Probably half of that risk is declined in underwriting anyway. So we're not too concerned that we lose in that space. Something I didn't mention is you see these age bands from age 50 to 75. Keep in mind that we're opening up the age range down to age 40. So you're going to be able to go from age 40 to age 79. Looking at the male with the 0-day wait for home care, same deal. We win in the same cells, and Thrivent wins in their same cells. Mutual of Omaha doesn't play too well in that space. And then again, to play the 5-year angle, a little more of a mixed bag. We go back and forth with Thrivent, and again, a little bit with Mutual of Omaha. Again, looking at the meat of the market, we give up a few dollars, if you will, to Thrivent, but still beat Mutual of Omaha. Meat of the market, I mean the age 60. So, so any questions or comments up to this point? Because we pretty much gave you the key points to all of this.
No, I don't see any questions, Larry, but I had a question with the age,
Yes.
40 to 79.
Yep.
Can you, and I think I've done this in the past a few times where they can be a little younger than 40, but they would do the 40-year-old age. Would they accept those?
Good question, Don. So the question is, can we save age? So with actual age, that's going to be a little different. You can save age, if you're trying to save somebody some money by getting older, but it's going to be very specific. If you're not 40, you're too young to apply. So yeah, the age nearest gives you kind of that flexibility, but when you're 40, you'll be 40.
Right. So I mean, if they're 38, they have to basically wait until they're 40. They can't come in and still have the rate at a 40-year-old.
That's correct. That's
Okay.
correct.
I want to make
Yep.
sure because I've heard somewhere in the past where there was an exception, but maybe I misheard on that one.
Well, so I'll tell you exactly what that exception was. That's a good point you're bringing up with our current product. So they came in, they were 39, and they were like within a week of that 6-month part where they were a year older.
Yep.
So we said, okay, that's close enough. I think if you find somebody who's maybe a month or two away from age 40, when you think about the length of the underwriting process, it's always worth seeing if we can do an exception, because if we can, we will.
Okay.
So never, don't stop and make the request and see what we can do.
And that's a good point. You bring up underwriting. You guys, and we've had some cases, and you may talk about this a little later on, maybe with underwriting, but every case that we've sent in, I tell you what, it's like white gloves. I mean, you guys are, if there's anything in it, you're giving us a call, or we're talking to the agent to find out a little more detail. Because I know I actually had one that was automatically declined a while back. That was a pretty
Yep.
large case,
Yep.
but we actually talked about it. We walked through it and we talked to the clients. And there was a thing that they basically, it was kind of a questionable answer on a question they had. So we actually went back to it. And between underwriting and, and yourself, we actually got it approved instead of an auto decline. They actually got it to approved.
Yep. Yeah, I'll talk about that. We do have a little bit of discussion on underwriting, so I'll address that. It's a good point you brought up, Don. I think first of all, when you think about our company, we're not a new company. We've been around 116 years, which is good, and we're a mutual company, which is even better. But in the case of LTC, we've only been at this since 2016, which actually is a really good thing. And I say that because we don't have to worry about any old legacy business that maybe was priced inappropriately 20 years ago coming back and biting us. We have a clean book. We came out priced correctly from the beginning at the level of lapse assumptions, interest rate assumptions, and morbidity assumptions. We're assuming that nobody lapses this product. So our profitability is extraordinarily high. And what makes it even more attractive is that given that we only have 5 active claims on the books, and that'll change. That'll definitely change in the next 2 to 5 years for sure. We just don't have any exposure, which is why we're able to offer this product at such a competitive rate. When we talk about underwriting, I think Don brings up, and it's something important here. First of all, we're getting pretty fast, right? Average turnaround time is about 24 days, right? And when you look at the number of cases we get through within 30 days, it's still very high. Unfortunately, you always have those healthcare providers that drag their heels and get medical records to us. But what Don's talking about is important in terms of our underwriting philosophy. We look at each individual as their own health story. and then fill in the gaps from that standpoint. We have underwriting requirements and parameters, of course, but the bigger picture is we look at their overall health. And what Don brings up is important. It's what we call an exception or an appeal. 24% of our declines are overturned in appeals. And you're probably asking yourself, well, what's wrong? I mean, why then are you declining them in the first place? Well, maybe we might see a situation where if we could see one more test, maybe they had a condition that left some question in the underwriting's mind, is it stable? Or if we can see one more test or one more treatment for this, um, that kind of a thing that's kind of what we look for. In many cases, we'll overturn those. We've had situations where the medical records were either inaccurate or not even theirs, right? They had their name, their social security number on it, but the healthcare provider had it incorrect on their side. So, yeah, what Don brings up is important. Is if when Don will call me, which he does, he's an advocate for you all out there. He'll call me and say, Larry, something doesn't make sense. Then we'll take a look at it, and then if I agree, and generally I do, I said, yeah, you're probably right. Let me run this by our head underwriter. And next thing you know, we'll get back the question of, we'll find out about these three or four things and then get back to us. In many cases, we can turn them around. So, yeah, the fact that we will look at appeals fairly is important. We have a couple of ways you can illustrate this. I'm not going to spend a lot of time here, but we do have an illustration tool that lives outside of our website that you have access to. And I can get this link to Don if you want to play with it. But with the new product, keep in mind, I don't have rates available for that yet. The rest of this, Don, is just kind of market stuff, and I don't think we want to bore your people too much with that. But at the end of the day, we're excited that Honest LTC will be coming out certainly within the next 30 days. You're going to hear from Don when that happens. And then we have a new e-app system as well that might be worth a review when the new product's out as well. So, Don, I don't know if that gets us where we need to go, but if there's any other questions from you or anybody else, I'm happy to take them.
No, I think it's great information. I know this is going to be coming out. Honest LTC, I love the name. It's straightforward and it's exactly what we're doing. We're helping the agents with clients and we're being straightforward with it. The e-app's going to be a nice tool. The easier of it, the questions are really now it's going to be calendar days, which is huge, I believe.
Yep.
Um, then I like the 10 pay option. I mean, if they're in younger, and if agents are listening to this, younger ages, look at that 10 pay. You pay for 10 years and you're done.
Yeah.
Now I know there was talk that it was going to be a 10-year rate lock. Did that ever happen, or is it just a 5-year?
Yeah, that's a great point. We filed the product with the 10-year rate guarantee, and the compact came back to us saying, no, you can only guarantee rates up to 5 years, which doesn't make any sense at all. And you know what we found out? There's a new carrier coming back into the market. I won't mention their name, but they lobbied with the compact to not allow a 10-year rate guarantee to put them in a more competitive light. And I don't know who they bought off or who they paid, but as a result, they said, our filing, sorry, you can only guarantee rates for 5 years. So with the new product on the 10 pay, 5 years of that 10 pay is guaranteed. So
Right.
not what we wanted, but it's what the regulators said. So
No, but just the 10 pay. I tell you what. So myself, and I don't know, Larry, were you included on? We did our work site office long-term care policy. It's been a long time. They don't even offer it anymore, but we did a 20 pay and they were twisting my arm when I was 27 when they did this thing. And they
mhm.
said, hey, you need to be part of this. And so I really was hesitant because I was only 27. Why do I need long-term care,
Yeah.
at that age? But I tell you what, I did the long-term care, and Wendy also did, my wife, and we were paid up at age 47. No
Wow.
more long-term care premiums at all. So if you can afford it, the 10 pay, it is a little more, but at the younger ages, you 10 pay and you're done. I mean, that's a huge benefit.
Yep. Yep.
And it'll
And
still grow with inflation and everything, but I like to show that even, to this day, I like the 10 pay option.
yeah.
The single pay, not so much. That's not a big thing being going away, but the 10 pay is a huge option. I think that people need to look more at for younger clients.
Yep. Yep. And what's interesting about the 10 pay too, uh, I'll throw a hypothetical out there. Let's say you're in a terrible car accident and you have paid up to year 5. And that car accident was sufficient enough that you actually needed, a lot of physical therapy. And quite frankly, it was a long-term care event for a year. We'll call it 2 years. So let's say after 2 years after you go on claim at year 5, that brings you to year 7. And now you're better. What happens when you resume paying premiums? Do you have to make up those back premiums? And the answer is no. You only pay what remains to be paid. So
Gotcha.
that's kind of a neat way to approach it as well.
It is. Larry, I appreciate you coming on today.
You
I
bet.
know everybody's busy, so we're going to wrap it up, but Merry Christmas, Larry. Happy New Year. I know we'll talk again unless
Yep.
you have something else we got to cover, but
I think everything important that you heard happened. So next time you'll hear from us is when it's officially out.
all right. Thank you again, Larry. Thanks everyone for being on. You guys all have a great day.
All right. Thanks, Don.
You're
Merry
welcome.
Christmas,
Thanks.
everybody.
Take care.
Mhm.
Bye-bye.